Major funding for these broadcasts has been provided by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding has been provided by AmTrust Title Insurance Company, AVR Realty Company, Bank of America, Merrill Lynch, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, JP Morgan Chase, Citizens Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Marinkoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
What's really happening in the investment sales? As my guest will say, it's asset location driven. So today I've assembled this group of business leaders, 3 investment professionals, and what's more important, the person who's buying and selling properties to provide their insight on the market. My guests include Tim King, who's the co-founder and managing partner at CPEX Real Estate Services, James Nelson, who is the principal and head of the tri-state region for investment capital markets at Avison Young, Giacomo Barbieri, who is the managing director for New York investments at TH Real Estate, and last but not least, Will Silverman, who is the managing director at Hodges Ward Elliott. So since you have been fine enough to bring Giacomo over here, what is he interested in buying? Since, it's like a tag team. No, all joking aside. How do you see the market today? Because one of the colleagues who's not sitting here said to me, I had a miserable year. I said, wasn't it better than 2010? I mean, it's a tale of two cities, right, Will?
I think it is. I think it's a tale of many cities, Michael. I think that on the one hand, we've had a little bit of capitulation from buyers and sellers. I like to say that buyers have realized that it's not 2010 and sellers have realized that it's not 2015, and they're kind of meeting in the middle a little bit. But it's very, very much dependent on product type. There are the things that the market wants, and if you've got one of them, the market is incredibly strong for them.
So tell me, what are the things that the market wants? You're a buyer and a seller.
Just to go back for a second, I think what you said with the introduction made a lot of sense, which is it really depends on asset-specific and location-specific nuances. You think about New York as a sub-market, as sub-markets, but in reality, it's micro-markets. There's certain areas of Third Avenue that behave differently, whether you're close to Grand Central or not. You look at what's being, what Hudson Yards impacting, and you hear over and over, it's 6th Avenue, it's Park Avenue, but the reality is it's only a certain portion of Park Avenue. It's the lower part of Park Avenue that has the large building with the big blocks with the big tenants. The north part of Park Avenue is actually doing quite well because it's more boutique-y, smaller tenants that are now getting pulled from Hudson Yards. So when you think about investment strategies, you got to look at the asset and how that fits and how you think it's positioned within the market. So
here's the question. The traditional buyer or seller that you're dealing with in general, and generically, how are they looking when they sell? Is it because they think the market's doing very well? Or, unless they're a private equity fund, that they have a certain amount of time that they have to sell the asset. I'm talking about someone else. How are they making a decision to buy or sell an asset today, James?
So motivation is definitely one of the first points for discussion. And for a long-term owner, it might just be a lifestyle decision. If you look at multifamily and rent regulation, which is so complex today that unless if you have the scale to operate 1,000 units, it probably doesn't make sense to own 1 or 2 buildings anymore. But yes, there are still serial sellers who are out there. They're nearing the end of the life of a fund and they need to sell. And I think there are still aspirational sellers out there who realize that you can still achieve maybe not peak pricing, but very close to it relative to what's happened the last 5 years. And they're looking to trade up. I think it's a great time to buy in this market with rates where they are. But again, we're brokers here, and the glass always has to be half full.
Since Tim and I are basically baby boomers, and we've seen the period of time, how do you see it? Okay, white old sage. Okay.
To me, I think, like you said, a longer view, and I think that up until very recently, I'm going to make a maritime analogy. It's as if we've all sailed into some sort of Bermuda Triangle, where all of the aids to navigation are gone. The buoys went dark, the radar's down, the GPS isn't working, and people don't know what to do. The seas are choppy and there's a fog coming in. So under those circumstances, people typically tend to either drop anchor or slow down the engines. So I think, anecdotally speaking, in the last, and I don't know that 6 weeks or 2 months makes a trend, but I do think that since the start of the year, there has been an uptick in activity and the phones are ringing and more people.
But what do you attribute this increase in activity? Because as I was saying before, some people were telling me that they were at a shiver or a wake. Why is it today? The Chinese, as we read in the articles, are not as active because they're having difficulty. Is it Tim or is it everybody seeing this increased activity since?
We've definitely seen a pickup in activity going back to the fourth quarter of last year. And as Will mentioned, you did see some capitulation in pricing, and that always helps. There's so much capital that's still on the sidelines. And when they see prices drop even 10, 15, or in some asset classes like retail, which is really the contrarian play today, they're going to jump in when they think the timing is right.
You bring up retail, and I have a buyer over here. I believe in New York City, and I'd like Tim to confirm it, borough retail is really not hurting, okay? Because there is a lack of retail in certain boroughs and certain areas. Manhattan retail may be hurting, but if you saw...
it's the high street that's hurting.
Right.
And I think that's because there's been an increase in pricing and asking rates because of assets trading at ever higher numbers. And that's created a bid-ask spread between landlords and tenants. But with regards to the borough retail, we like it. We are not exposed to it. We would like to. We haven't found the right asset. I think Brooklyn has 5 square foot per capita in retail versus a national average north of 30, I think. Mm-hmm. So the density store is very strong, and the performance is there. It's a tough asset class, though, because you need to accumulate it to really have size. It's kind of like industrial. You can never have enough. We also like high-end malls because we think that retail format still will be necessary for retailers. I think we talked about it last time, is bricks and mortar store are changing in the sense that they're no longer just driving sales on site, but they're driving sales online. So the retailers still need that touch point.
I mean, let's, if we look at the Warby Parker, the Barnabas, and a variety of people, the bricks and mortar retail over there, even look at Casper. Okay, Casper right now is in Target. So there's a variety of situations, okay? And then if you look at it in a different way, Gilt is in in Saks or Fifth, but I think there's a change. But you've seen retail over the years change also.
Retail has evolved, and I always make the analogy that there was a time when people talk today about internet shopping. The Sears Roebuck catalog 100 years ago was the internet shopping of the day. People still ordered stuff by mail, just came a little bit differently. Retail is the ultimate Darwinian business. Either you're green and growing or you're ripe and rotten. And to your point earlier, there's no question that Brooklyn in particular, but I think you could say the same of almost all the outer boroughs, are significantly understored. The demand is there. And in certain neighborhoods, as we see the new density of residential development, retail is always the lag. So first you bring in an influx of new tenants, and then all of a sudden folks need the liquor store, the dry cleaner, the grocery store.
So here's a question, and it relates to everyone sitting over here. You know, there's an enormous amount of new office buildings being constructed in New York. The Hudson Yards came out of nowhere. I tell people that many years ago I worked at 441 9th Avenue when the building was a warehouse and some office, and there was nobody you wouldn't walk out the neighborhood after 6 o'clock at night. Look what has happened in the Hudson Yards. So you have a lot of companies going over there, and you have a lot of vacant space coming that's going to be repositioned, like on 3rd Avenue, 6th Avenue, and so on. How are you seeing the investment opportunities for office buildings today in the city?
Well, I think to echo Giacomo's prior point, it really comes down to micro arguments and micro markets. I think there are specific types of real estate that are being delivered in Hudson Yards, but Hudson Yards is not replete with deliveries of boutique spaces. So boutique spaces on the high end are doing very, very well in other locations, be that Meatpacking District or Plaza District, right? And the buildings that are ostensibly supposed to have been the losers in this fight so far, which are the large-scale buildings on 6th Avenue and some of the other ones in Midtown, are beginning to reinvent themselves. Because the thing that you can do if you've got 2 million feet and 4 levels of concourse space is you can create an incredibly amenitized experience.
I mean,
for your
what the
tenants.
Rockefeller Group has done in their properties over there, they've changed it. What RXR has done on their properties,
Exactly.
they've taken the property and they've changed it. I mean, it's not the old McGraw-Hill building over there, so it's been amenitized. And I brought it up briefly in the green room at all the proliferation of industrial properties which have been converted to office buildings. James, Giacomo?
Yeah, I would say for the boroughs, first of all, the total office stock relative to Manhattan, which has 400 million square feet of office, Brooklyn has roughly 25 million, maybe another 15 planned. But it would seem that a lot of that space is more catered towards the boutique user. We're seeing a lot of that flex office, but it still has to be priced competitively. You look even downtown and what the financial district is offering. I mean, there is still value in Manhattan, so it has to be the right space and the right pricing.
I think you're absolutely right. It works, and we think it's going to work over cycles, but it has to be at a deep discount.
Right. You can't rationalize $60 a foot for that type of property. It may be a $35 to $40 type of property over there. When we're talking different asset classes, how are we looking at the residential? Because as James was saying, you need economy of scale. You're saying you needed 1,000 units. Are you looking at the residential? You'd mentioned Williamsburg. You're looking at it on a market by market situation?
We're very selective. We're not extremely active now. We bought a lot of residential early on in the cycle. And to the extent we're looking at more seasoned properties, not the newly constructed. We like the idea of buying a property and working on it, kind of actively managed core. We've seen a lot of deliveries in the luxury space, and I think that's really hurt the fundamentals. I know you're thinking on it, which I think it's the point, which at some point that's going to be all absorbed, all the slack. But to the extent we become active again, I think it's just going to be the seasoned properties.
Yeah, I'll say something controversial just for fun and get the party started. You could make a very reasonable argument that multifamily development in Manhattan after 2019, and there's barely anything scheduled to deliver after 2019, just kind of won't be much of a thing for the rest of our careers. And the reason for that is that right now, any given site south of, say, 125th Street in Manhattan is worth, at a minimum, twice as much as condo as it is as rental. And that spread goes up to 10 times as much. And the only place that we might see sources of new multifamily development in Manhattan for the foreseeable future are maybe a nonprofit that can only do a ground lease that for some reason can't be a co-op, or if there's a rezoning. But conversions of office buildings are out because the rents are too high on the office buildings relative to the residential. So we could be looking at a moment.
The loss factor of converting an
Bingo.
office building, it's not even that. The space conversion, you have a 30 to 40% loss factor.
Exactly. So a 13,000-foot office floor becomes effectively a 7,800-foot residential.
Right, and in an office building in New York City, that 13,000 square foot is now 16,000 square feet because of the tape measure.
So Michael, what we're looking to is, if there's going to be de minimis deliveries of multifamily in Manhattan going forward, what's the impact of that on multifamily in Manhattan? And then what's the impact of that on multifamily in the inner ring areas of Long Island City, downtown Brooklyn, Williamsburg, and dare I say it out loud, Jersey City? Right? So I think that there's actually reason for optimism in a lot of those markets.
You didn't talk about where everybody believes there's great opportunities. Staten Island, the Bronx. I mean, all these new buildings being built in the Bronx, it depends on traffic and it depends on safety. And
Well, I think
I think it also depends on transportation
Right.
and the subway. And to Will's point, I think we're in complete agreement on Manhattan. But yes, as we go into the boroughs, I'm currently involved with a site that's 400,000 feet of buildable in East Williamsburg. It sits adjacent to the JMZ and G trains. And that site right now is about to trade at just a shade under $250 a buildable, and we are only getting interest from rental buyers. And what I will say is this new Affordable New York plan, which is the predecessor to the 421A, the developers like it. It's a very good program.
In a way, it's a much better program.
It's a great program, and on top of it, and I think you were going in this direction, so not to steal your thunder, but I appreciate the
Plenty of thunder to go around.
This new tax reform, multifamily is going to be a big winner, because what's going to happen in high tax states like New York is that first-time home buyer is going to hold off on purchasing because they're looking at the fact that they're losing SALT and how much they're going to have to now come out of pocket. They are going to delay that first purchase. And I think that may even save the luxury rental market. So, I would definitely hold tight for now on, your product that you bought 4 or 5 years ago, because I think it's going to fare well in the future.
Yeah. Timmy?
I'm just curious. I want to write down what Will said, because it's interesting to see. I understand the logic of what you said. What I've often seen is that every time people make pronouncements like this that do have a lot of logic around them, the law of unintended consequences comes along and smacks us all in the head. Mm-hmm. But I do think it bodes well, obviously, for the outer boroughs.
I have a question which relates to trends and different ideas. We have WeWork today. We have Airbnb today. Where do you see those effects on the office market, and where do you see it on the hospitality market? Any thoughts? For investment purposes.
So I think the way we work has completely changed. A lot of it has to do with cell phones, right? We can be connected at any time. The quality of information we get is very high. And so you don't have to go into the office anymore, right? You used to have to go to the office to do your job. You don't have to, right? And that's been highly adopted by millennials, who are the majority of the working population. What they're asking for in return, though, is that when they do go to the office, their experience has to be much more amenitized, much more service-oriented. But employers understand that. And players like WeWork have gotten it right, to the point where Amazon has 7,000 employees in WeWork space. In terms of the impact on the office space, on the office market, what I think that means is not what Convene or WeWork says, that in 10 years there's 90% of the market's going to be on a 1-year lease for office. I think, though, that the need for that flexibility in amenitized space has fundamentally change the market, to the point where the market itself, landlord, might actually end up reserving a piece of their building for that swing space, for those amenities. They will charge 150% of rent, but the tenants can contract.
Right, but you're saying in many cases it's going to be the landlord who's operating it.
That's what I believe it's more likely to happen.
And I believe you're correct, Because certain landlords today are taking that into consideration and operating it and say, look, I don't have to let the other guy make a markup. It's getting rid of the middleman.
Yep.
Okay, I agree that it's nice to be part of the WeWork network, but there are other. The Yard is doing well. A number of others not as doing well. Convene is a different type of product over there. Yes, Tim.
Well, to that point, smart, shrewd operators, folks like the Walentis family in Dumbo, have done that sort of thing since the beginning. Incubate tenants in smaller spaces, in fun spaces, and then when they're able to grow, they can accommodate them someplace else in their campus. It's the same thing that, like Andrew Kimball is doing in Nutri City, where they're bringing in tenants that have made 3 or 5 employees, and they're hoping that in 2 years they're going to have 50 employees, but they'll keep them on the campus.
You know, right now, the Milsteins have a building at 335 Madison Avenue. Within the building, they have incubator space. They're providing incubator space. I did a show on tech. This is becoming a lot of companies, a lot of landlords, a lot of the major landlords who used to only own real estate are owning technology companies. With regard to hospitality, how do you see hospitality assets? Are they selling, doing well today? Or is Airbnb and other effects having an effect on it?
I work for a firm that largely does hospitality historically, and I know next to nothing about it personally. I pick up only by osmosis. So it seems like the market is starting to clear some of the hospitality product in New York City. I think there are still people. I think what's starting to happen is maybe that's becoming a way that people get introduced to the city that weren't introduced before. And then they become more traditional hospitality customers. But beyond that, I'm swimming out of my depth quickly.
Now you said
And I
you
work
like,
for a firm that does not invest in hospitality. So I can't.
so what's interesting is you have a firm who likes retail, high-end mall retail, but doesn't like the hospitality, which is not surprising because hospitality is a day-to-day business. Each and every day, the cash register has to open and close.
And it's an operating business, right? It's before it's real estate. It doesn't matter if your hotel is 2 blocks off. What matters is your booking system and how you manage expenses. That's it.
What about,
Yeah. So it's less about the bricks and mortar.
Would you invest in land?
We do under different formats. So we'll do development. We are not active right now buying land for ground up in the United States. We do that very heavily in London and in Asia. In the United States, we have a program that invests in ground leases, a fee position on the ground leases, just as a bond type investment.
What about land? What's selling with you? You just mentioned the site in East Williamsburg.
Yes.
What are we seeing in land?
Yeah, certainly at the right price, you can do rental, and there is demand for that. For land in Manhattan, that's a more interesting question. I might contradict what I earlier said, which was there isn't going to be as many first-time home buyers. That being said, the under $3 million space still seems to be moving briskly. So if you look at how much condo product there is in Manhattan, there's only about 5,000 units on the market. The challenge is, and what ends up on the cover of the New York Post is, this $30, $40 million apartment that had to slash its price and sell for, 50% of that. But that, 10 million plus, that only accounts for 100 apartments that sell a year. I mean, it's de minimis. So it still seems that if you can deliver that 2-bedroom for under $3 million, there's still a void there and an opportunity, and it seems like there's finally some financing as well to go out. So we are now starting to get those calls too in Manhattan from developers looking to do very specific type of condo product.
What about foreign investors? Are we seeing foreign investors in Brooklyn and the boroughs?
Money, yes, but not as principals. They're the money behind, but they need a local developer or a local operator to build or to run for them.
James?
Absolutely, and it's still the Chinese with the currency control, they have stepped back a bit, but there are so many countries that are always looking, and New York is still the safety deposit box of the world.
Absolutely, absolutely. And I think what's going to start to be the story is, even as some Chinese investors are on the wane, there's private money from other parts of Asia, and particularly Hong Kong, and we're on the front end of the second Japanese wave.
What's your thoughts about like Jersey City and Newark?
I like them a lot. We spent a lot of time in Newark trying to come up to speed. I think industrial will be our first foray there because a lot of industrial tenants have been displaced for those projects that are converting industrial to office in Long Island City, and you're going to need $20 rents within access of the city.
Yeah, I think
Jersey City. The Jersey City is the other. I think it's going to be the star of the next 10 years.
even with all the new development taking place.
Well, depends on what you do. I wouldn't suggest you buy core, newly developed residential. Maybe you get in earlier and you do the ground up, but I think there's going to be density, there's going to be more retail added, and there's going to be, if not a thriving office market, certainly a good commercial scene.
Since I have two Connecticut Yankees over here who both live in Connecticut and near each other, correct?
Mm-hmm.
What's your thoughts about the Connecticut market?
From an office perspective, it's not a market that I track very closely. From a residential perspective, what I think is likely to happen is that as millennials get older and have second children, you are going to see more and more of them going to the burbs, but the burbs that they go to will be a little bit different. So for example, in Greenwich, where James and I live, the areas where we live that tend to be higher density areas where people know their neighbors and walk around to other people's homes or to amenities a lot are doing really well. The historically strong area where the horses are is not doing so well. And I think that's a preview into what's to come.
Look at Stamford. Stamford is
it's having a real resurgence, especially on the waterfront. But I do think you have to really see where the job growth is happening. And over the last 7 years, New York City has consistently been adding 100,000 new jobs per year. And that is the most important driver for us. Meanwhile, the suburbs are, 1/5, 1/10 of that. So I think it's clear where people want to live and work. And I think that's still in New York City. However, and if you look at what RXR is doing in White Plains and adding New Rochelle, adding 5 million square feet there, I'm sure their bet is that if you hop on Metro North, you can be in the city
26 minutes.
in 26 minutes, which is a lot quicker than some of the commutes
I recently did a panel on transit-oriented developments in the region, and what's happening is certain towns like White Plains, New Rochelle, are very pro-developer. You can get something in and out of operation, while certain towns like Chappaqua and Scarsdale are nightmares. So the market is different. But I mean, in summation, how do you see 2018 for investment sales?
I think demand will be strong, and I think we'll have an uptick in activity.
I think it's going to be steady steady, and we're actually going to be net sellers this year versus net buyers.
Why are you going to be a net seller versus?
It's mostly recalibrating our core strategies to do something that is more actively managed core, we call it, something where you can actually increase income. So we're actually disposing of the properties that we think are going to provide less appreciation over time.
Mm-hmm. And we're coming off last year where dollar volume dropped 50% year over year, but the number of sales only dropped 18%. So I think we're going to definitely see more dollar volume this year. Number of sales, I think, is flat, and pricing, again, really depends on what asset class.
And my fellow baby boomer?
Better than last year, but not as good as 15.
Okay, so I'd like to thank Tim, James, Giacomo, Will. See you next week.